Hi, my name is Nicole. In this video, I want to get us to think differently and trade smarter. And we're going to do this by using a different option strategy for strategic stock acquisition. I want to challenge how many of us have been taught to think about options. Most options education is really just technique memorization. You may have heard the best way to make money with options is to always sell premium, or always sell 15 delta puts and calls between 30 to 60 days to expiration, take them off when they're 50% of max profit, and rinse repeat, or always roll at 21 days, or another one would be never take assignment. These rigid rules might seem helpful, but they actually limit your creativity and adaptability in different market conditions. Let's talk about how options aren't just income generating tricks, but how they can be strategic ownership tools. In this video, we're exploring a twist on a strategy that's probably familiar to many of you: put credit spreads. One of the most well-known and popular ways to use options is to sell cash-secured puts on a stock at a price that you would like to buy the stock. Most of you know that selling a naked put option obligates you to buy shares at the strike price if assigned. With a naked put option, your maximum risk is essentially the strike price minus the premium received for selling the put option. Let's hop into the trading platform, and you can see that I populated United Health Group, and this stock has taken a beating over the last couple trading weeks, at one point trading down over 60% from its most recent highs. So let's assume I want to take advantage of this sell-off and the increase in implied volatility to sell some puts in this stock. First, I want to take a look at the implied volatility readings for the different expiration cycles I might be interested in selling to see if anything jumps out. In this particular example, nothing unique really jumps out. Implied volatility is high across the board. And let's assume I want to sell some premium in the June 20th, 2025 expiration cycle. And a lot of times I look to sell near a 30 delta. This puts us at the 260 strike price. And if I were to click on the bid there, we can see that I could receive $11.65 in order to sell that put. And we can see that the credit received then would be $1,165. The max loss in the position would be $24,835. And the break-even stock price, which is the strike price minus the credit received, would be $248.35. And the max loss, of course, would be realized if the company went out of business and the stock went to zero. This approach sounds great. However, when you sell a cash-secured put and the stock drops significantly but rebounds before expiration, you face a particularly painful form of opportunity cost. Not only are you playing defense on your short put position, but you miss the chance to buy the stock on the dip, which could have resulted in substantial gains during the recovery. Instead, you're left with just the original put premium, which often feels inadequate compared to what could have been. This situation creates a psychological dilemma that can be maddening. If the put expires worthless, you only keep the premium, which at the time of the sale seemed reasonable. Had you waited and bought shares on the dip, your returns could have been much greater, and you feel like you're essentially watching from the sidelines as you watch the stock make a dramatic recovery. This is especially frustrating because the original thesis might have been correct. You liked the stock at the strike price, but the timing and the mechanics of the strategy prevented you from maximizing the opportunity. The popular enthusiasm for selling naked puts often overlooks crucial considerations. Selling naked puts offers linear downside risk with capped upside. This is essentially the opposite of what most sophisticated traders typically seek. It could be argued that the risk-reward profile is inherently unfavorable, giving you small premiums for potentially large losses. So what if we could employ a more sophisticated approach that would give us the ability to dynamically adjust positions based on market movement in order to create asymmetric opportunities to obtain superior long-term results rather than just collecting small premiums while accepting large downside risk? Enter the put credit spread. Here's where we level up. Instead of just selling naked put options, we're going to look into buying a cheap put option or a wing that's further out of the money. This creates a put credit spread, which changes everything about your risk profile. With a put credit spread, your maximum risk is the width of the spread minus the credit received. So let's hop into the trading platform and take a look at what a put credit spread would look like in United Healthcare. And we're going to populate the same expiration cycle as the previous example. And let's say we're interested in selling the 260 strike put option. And instead of just doing that naked, we're going to go ahead and buy a further out of the money put at a relatively cheap price. And we're going to look at the 200 strike put. So this is a 60-point wide put credit spread, and you can see that the credit received for this put credit spread is $958. We have a max loss of $5,042 as opposed to over $24,000. And the break-even stock price on this one is $250.42. So that would be what a simple put credit spread in United Health would look like compared to the naked put from the previous example. So here's why this approach is powerful. You're collecting premium while waiting for the stock to hit your buy price, the strike price of the short naked put option. You've defined your absolute worst case scenario. No matter what happens, even if the company announces bankruptcy tomorrow, your max loss is capped. And if the stock does crater unexpectedly, that long put wing can become incredibly valuable and versatile. So the value of this strategy comes into play when you only sell as many put credit spreads as you'd be willing to take assignment on. And this forces incredible discipline. Since each put spread requires less capital than selling a naked put, there's a temptation to sell more contracts. Don't fall for it. Remember, the primary goal here is strategic stock acquisition, not just premium collection. So let's talk about some implementation tips. Remember, the primary goal here is strategic stock acquisition, not just premium collection. So let's talk about wing placement. There's no one-size-fits-all rule. If your short put is near the money, because that's the price that you would like to purchase your stock at, you might want your wing a little closer for better protection. If you're selling a put that's further from the money, you might want your wing to be a little wider. Let's talk about size discipline. Only sell as many put spreads as you're willing to take assignment on. This is not about maximizing premium, it's about acquiring shares at your desired price with enhanced protection and more flexibility. Next, stock selection. This strategy obviously works best on stocks that you genuinely want to own. Do your fundamental research first, then use options as the strategic entry tool. And finally, expiration cycle. There's no one-size-fits-all rule here either. However, often 30 to 90 days offers the best balance of premium decay and position management flexibility. However, some may find opportunities in shorter expiration cycles. Let's talk about managing challenged positions. Scenario number 1, the stock falls below the short put strike. Since your primary goal is stock acquisition, we have several strategic options. First, simply prepare for assignment. If your fundamental thesis remains intact, this is exactly what the strategy was designed for. You'll be assigned shares at your chosen strike price, reduced by the premium received. Remember, you selected this price because you believed it represented a good value. Next, you could close the spread and buy shares directly. If the stock has fallen significantly and you believe it's oversold, you might close the put spread, taking a partial loss, and buy shares outright at the current market price, which could be below your short strike price. And next, you could consider legging out partially. As the stock approaches your short strike, your long puts will likely start to gain a significant amount of value. You could sell all or a portion of the long puts to lock in gains on that component of the spread. Since you're prepared to take assignment anyway, the proceeds from the long stock puts could simply be used to reduce overall cost basis on the position. Scenario number 2, the stock falls below the long put strike. Since our primary goal is stock acquisition, we have several strategic options here as well. So in this scenario, the stock will have fallen more dramatically because it's falling through both legs of the put credit spread. In this scenario, if your fundamental thesis has changed due to whatever caused the dramatic sell-off, you can close both legs of the spread, so you can close out of the spread completely. The profit from the long put will offset a portion of the losses on the short put, allowing you to walk away with defined limited damage. Next, you could leverage the discount opportunity. If you believe the stock is now significantly undervalued, you can sell the long put wing and use the profits to buy additional shares at the discounted price or purchase call options to position for the recovery. Remember, you're prepared to purchase those shares at the short put strike price, so this is a very good option. This is a powerful approach using the protection mechanism to actually increase your exposure when the asset is on sale. So let's analyze what we just talked about in the Thinkorswim trading platform using United Health Group stock. As mentioned previously, we can see that the stock has experienced some dramatic selling over the course of the last month or so, and the stock is now trading down at levels last seen in 2018, 19, and early 2020. And I don't believe anyone could have foreseen the dramatic selling that we saw in the stock last week. So let's just calculate just how far this stock has fallen. And if we take the high and the low and the difference and make the calculation here, we can see that the stock at its lows had fallen 60% in value since the highs seen just a few months ago. So knowing me and knowing my personality, I might have been interested in stepping into taking a position on this stock as it approached the 450 price level, just because looking back in time here without a crystal ball, we can see that there were reasons to believe there might be some support at that price. So when I take a look here at the daily chart, we can see that that 450 price level did hold support in February when the stock was challenged, and that would have been more reason for me to look to maybe sell puts on the stock as it approached 450. Now we can see here it was approaching 450 and sliced through it on April 21st of 2025, and we know what happened to the stock afterwards. So this is a perfect stock to do an analysis on. Should I have sold a put and then compared that to if I sold a put credit spread with the intent for acquisition of stock on each position? And let's just see how that would have played out and how I might have chosen to manage that should I had an active position on over the course of the last few weeks. So as that stock would have been selling off, you can see here in the analysis tab, I have April 21st populated, which was a big red candle, and that would have been a day I would have wanted to sell some premium here. And I would have probably gone out about 60 days and looked to sell close to the 30 delta put with the intent to take assignment on the shares. And that would have come out to be the 400 strike put in the June 20th, 2025 expiration cycle. And if I would have sold a put there, we can see that I would have received a credit of $14.35 for doing that. Highlighted there. Now, let's compare that to selling a put credit spread in the same expiration, so we're comparing apples to apples. So I would have probably sold the put at the same strike with the intent to acquire the stock at that price. And just looking at the put prices here, if I would have gone down $50 to 350 strike, I could have put that spread on for just over $1,000. And for just over $1,000, I think that spread, just knowing me, would have looked like, worth taking the risk on. At that time, of course, I would not have had a crystal ball. And to just highlight what that individual 350 put would have done, I just went ahead and selected purchasing that. So we can analyze that separate from the spread as we move through time. So one thing that's nice about this Analyze tab here is we can put the position on April 21st, 2025 in the Think Back section of the Analysis tab, and then move the trades forward in time to see how they reacted. So I highlighted the positions there in the lower right corner of the screen so that we can see how they would have behaved individually as we move forward in time. And it was a little hard to read there, so I'm just going to re-highlight that section. And as we move through time, let's take a look here at how those positions reacted. So in late April, things are kind of bopping along. Not much is happening. The spreads are kind of waffling between being somewhat profitable to basically break even. And as we head into May here, this is when the selling and the weakness started to really show in United Health. So both spreads here on the 5th, we're starting to take some heat. And as we move through time here, we can see as the selling intensified, both positions are taking heat. Not much difference between the two of them at this time. But as the wheels really started to come off that stock, as we move through the week of the 12th here, we can see that the selling intensified on the 15th and on the 16th. And we can see that the difference here between the naked put and the put credit spread is pretty dramatic. So the naked 400 put is down $11,430. And we only took in about $1,400 in credit to sell that put. And remember, we wanted to take assignment at 400, which would be a $40,000 cost to purchase those 100 shares at that price. And if we were to get exercised on that put, that investment would be down by $11,000. Okay. Now, conversely, on the put credit spread here, we can see that we would definitely be taking heat on that position, but we'd only be down a little over $3,700. So if we were to get exercised on that 400 put, yes, we'd cough up the $40,000 to buy the 100 shares, but we do have a profit here of about $7,660 on the 350 put that would help offset the losses on that. So just taking a look at this, we can see where the value of purchasing the wing, in this case the 350 put, could be super valuable. So remember, that put now is showing a profit of $7,600. And if we're still bullish on that stock, despite the news that came out, or maybe we're even more bullish now, we may look to use the profits on that 350 put opportunistically to position for a rebound if we think that that's going to take place. And we're just highlighting the profits here on the 350 put, about $7,600. And let's just take a look here to see what we might want to do if we wanted to take profits on that put. How we could create a scenario where we could create a position with a little bit of asymmetry. So if I were to go ahead and go out to the January 15, 2027 expiration cycle, these options expire in just over 600 days. We can see that I could buy an at-the-money call for roughly $7,500, a little less there. The bid asks are pretty wide. And I could move up in strike and move further out of the money and go ahead and use the proceeds from selling that long put, that 350 put, to purchase either an at-the-money or out-of-the-money call on UNH to be positioned for a rebound should I think that might happen. Now, conversely, I could sell that put and just buy shares with that. So let's calculate how many shares I could buy if I sold that put. So let's just round down. The put's $7,600 in profit. And let's just say I could pick up shares for $290. I could pick up about 25, 26 shares of United Health just from the proceeds of selling that put. And that would add to the position. And that's assuming that I'd still be okay with purchasing the 100 shares of UNH at $400 a share. So you can see there where we could use that dramatic sell-off to add to the position while it's on sale if we're nervous that the stock is going to rebound and that the selling was just a temporary blip on the screen. Let's talk about some key takeaways. The beauty of this approach is that it transforms how you think about options. You're not just collecting premium, you're strategically positioning yourself to acquire quality assets at better prices while maintaining protection against black swan events. Remember, the wing is cheap insurance against catastrophic risk. Only sell put credit spreads on stocks you actually want to own. And size your positions based on assignment capacity, not maximum premium. When the stock falls, your wing creates multiple management paths, not just one. And let the strategy work for you psychologically. When you're prepared for assignment, market volatility becomes opportunity instead of threat. So I want to wrap up the video here. I was mowing my lawn last year, and the field across the street, I was surprised to look up and see these two bear. And this is to demonstrate that you never know when the bears are going to come out and play. You always have to be prepared. And how can you be strategic and opportunistic when the bears do come out and play? So if you like this video, please like, share, and subscribe. As always, thanks for listening, and be awesome.